Everyone argues over which AI model wins. Nobody asks who owns the buildings they all run inside. Two companies own over 570 data centers between them. They host Amazon, Microsoft, Google, Nvidia, and Oracle, and they collect rent every single month. The AI landlords are printing money, and you've probably never heard of either one. Equinix operates over 270 data centers across 77 cities on 6 continents, more than 10,000 customers, over 500,000 total interconnections. They just guided 2026 revenue at 10.1 to 10.2 billion, making it the first data center REIT in history to cross 10 billion. Q4 bookings surged 42% year over year. 60% of their largest deals were driven by AI workloads, up from 50% earlier in the year. CEO Adair Fox-Martin told analysts, "We were built for this moment." The stock jumped 14% in a single day, its biggest move since 2012. Digital Realty operates over 300 data centers in more than 50 cities, $73 billion enterprise value, 20 consecutive years of revenue growth. Customers include Amazon Web Services, Microsoft Azure, Nvidia, Google Cloud, and Oracle. They reported record 2025 results with earnings jumping 66%. 2026 revenue is guided at 6.6 billion. Together, 570 plus data centers, 16 plus billion in combined revenue. Two companies that quite literally house the entire AI revolution. Here's why these are different from every other AI stock. REITs pay mandatory dividends. By law, they distribute at least 90% of taxable income. Equinix just raised its dividend 10%. Digital Realty yields 3.3%. You get paid to wait, but the real advantage is recurring revenue. These aren't one-time chip sales. Tech companies sign multi-year leases. They install billions of dollars worth of equipment in these facilities. Switching costs are enormous. Once you're in an Equinix data center, you don't leave. That's why Equinix's retention rates are among the highest in commercial real estate. And the inference shift just changed the game. AI training happens in massive dedicated facilities. But AI inference, running models in production, happens at the network edge, close to users. That's exactly where Equinix and Digital Realty have been building for 20 years. But the landscape is getting crowded. Blackstone, which we covered recently, is launching a publicly traded company to acquire data centers. They have a $100 billion pipeline from QTS alone. Iron Mountain is pivoting hard into data centers. And the hyperscalers themselves, Amazon, Google, Microsoft, are building their own facilities at record pace. Mag 7 capex is projected at 430 billion in 2026. If the hyperscalers build enough of their own capacity, third-party landlords lose pricing power. Land scarcity and power constraints in major markets help the incumbents. But competition is real and accelerating. Valuations are also stretched. Equinix trades around $1,070, Digital Realty around $150. Both are priced for sustained double-digit growth. Any slowdown in AI spending compresses the multiple fast. So what's the chaos capital take? If you believe AI infrastructure spending is a multi-decade cycle, data center REITs are the cleanest way to collect recurring income from every AI company on Earth. You don't need to pick which model wins. You own the building. Equinix is the premium play. Higher growth, inference-focused, global network effects. 24 of 24 analysts rate it strong buy. Target around 1,077. Digital Realty is the value play. Cheaper valuation, higher dividend yield, wholesale exposure to hyperscaler training. Deutsche Bank named it their top pick for 2026 with a 180 target. For diversified exposure, the Global X Data Center and Digital Infrastructure ETF gives you both plus smaller names in one basket. Chips get the headlines, software gets the hype, but the buildings that house it all, those collect rent every month from every AI company on Earth. That's not a trade, that's a toll road. The capital markets are chaos. Embrace it, and I'll see you in the next video.